Hi, everyone. Thank you so much for those of you that have joined. My name is Emily Sides. I am a financial advisor and partner on the Sides Wealth Advisory Group team. If you are not familiar with me, you might be familiar with somebody else on the team. If this is your first time joining one of these presentations, I just wanted to give a quick overview of how they work so you know what to expect. Every quarter, we try to cover a different financial wellness topic. Our intention is we block off a half hour. We try to give you content for about 15 to 20 minutes and then open it up to questions at the end. If you would like to speak to us offline, you are more than welcome to reach out to myself, or again, if you're more familiar with someone else on the team, you can reach out to them directly as well. They're well aware of what we're covering today. So again, please don't hesitate to reach out to us if we talk about something here in the next 30 minutes that you would like to take a deeper dive into your own situation. So again, 15 to 20 minutes of content and then some time for questions at the end. Today, we're going to be talking about insurance. Last quarter, we covered budgeting. Our next presentation will be in October, and the schedule for that is to cover planning for retirement. So let's get started. All right, so what we'll be covering today, we're going to be talking about why you should consider life insurance. We're going to talk about determining your needs for coverage when we think about life insurance. We'll talk about strategies for different stages of life. We'll also talk about some options for business owners. It's not listed here, but we're going to also briefly touch on disability and long-term care insurance, and then also assessing potential risks. So today, we have a lot more insurance options than most of our ancestors did. If you think back to 30, 40, 50 years ago, there was insurance, but not to the capacity that we have access to it today, nor did they have the abundance of different types of products that we now have access to. So it's really great that we have all these options. I'm sure if we think about where we'll be 30, 40, 50 years from now, there's going to be even more options that can really help and support us when we think about insurance. So, life insurance provides parents of young children reassurance that their kids will have financial support if either parent or both were to die unexpected. I think that's how we all really think about life insurance, is support if somebody dies. It can also help people who are in their peak earnings years protect their wealth while they're doing that, accumulating tax deferred income. People who are also thinking ahead and developing estate planning strategies can incorporate life insurance into their plans so that they can give more to future generations and hopefully less to the government, to the IRS. Life insurance business owners can also use life insurance as a strategy to help secure their business operations if there was a change in ownership, loss of a partner, for reasons like that, which again, we'll discuss in a little bit. And then lastly, I think I'll mention this quite a bit throughout the presentation, but some individuals and business owners can use life insurance to benefit charities as well. You can actually list a charity as a beneficiary instead of an individual. So another way to think about life insurance. So all things to think about when we're talking about insurance here. So first, determining your needs for insurance. So life insurance, again, is typically purchased to provide a surviving spouse, surviving child or children, or another named beneficiary with financial support for them to be able to maintain their lifestyle. Maybe it's to pay off debt or fund a future expense. So how much is that? How much coverage do you need to do all of those things if someone were to pass? As you might guess, that could take a little bit of time to figure out, and everybody's situation is a little bit different. So a good way to start is by looking at your routine living expenses and your take home after tax pay. How much are you currently living off of? In addition to that, you'll want to look at any outstanding debt that you have, mortgage, car, college loans, anything like that. And then the third piece of this is any additional future expenses that you plan to incur. Maybe it's that you plan to help fund your child's college tuition, and that's a future expense that you need to plan for. So all things that you need to think about on your own personal situation. I'll mention this again at the end. We have a really nice worksheet that we're going to send out to everybody that's on this call that takes a deeper dive into your own situation that you can complete to figure out how much coverage you might need in life insurance. So again, that will be sent out after this presentation. There's also some other ways you can think about how much coverage you might need. They're a little bit of a simpler approach, and it might not be for everybody, but another way to think about how much coverage you might need pretty simply is just to take 6 to 10 times your salary, and that might be enough coverage for you. Or another approach is to multiply your annual salary by the number of years you have left until retirement. Again, that's not going to get into all the detail we just talked about with expenses and debt, but can give you a rough indicator of how much coverage you might need right now. So let's spend some time talking about different insurance products. So we're going to spend some time talking about two different types. We have permanent life insurance and term life insurance. Permanent life insurance provides lifetime coverage, so coverage for your entire life. There's different types of permanent life insurance. Whole, variable, and universal life are pretty common. And then we have term insurance, which I'm guessing is what a lot of us are most familiar with. So term insurance is coverage for a predetermined period of time or a preset term, usually anywhere from 10 to 30 years. So before we take a deeper dive into both of those, I just wanted to cover a couple different terms that are used pretty frequently when we talk about insurance. Those are premiums, cash value, convertibility, and face value. So premiums are that monthly, quarterly, or annual payment that is required to maintain coverage. You can typically customize when you would like to pay those premiums. So if it works better for your financial situation to pay those premiums every month, you can do it that way or annually, however you would like. Cash value, this is not to be confused with the face value, which I'll talk about in a minute, is the tax-deferred savings portion of a permanent policy that can be borrowed. So term insurance does not have a cash value, permanent insurance does. Again, when you have permanent insurance, it's going to continue for your lifetime. You're going to accumulate a cash value as you continue to pay premiums, which we'll talk about again here shortly. So again, permanent insurance has a cash value. Convertibility, this is just the option to convert from one type of policy to another. Say maybe it's a term policy that at the end of the term you'd like to convert it to a permanent policy. Not every insurance policy out there is convertible, but know that that can be an option. Oftentimes, if you are converting a policy, especially from term to permanent, you're going to be paying an additional premium for that, and it might require additional documentation and examinations for that. And then face value. Again, not to be confused with the cash value, is the death benefit associated with the policy. So let's spend some time talking about term insurance. So term insurance is typically a much less expensive option to getting life insurance coverage than permanent. This is especially true the younger you are. The older you get, the more you're going to have health risks and concerns, and therefore the premiums will likely be higher. So it's typically a pretty inexpensive option for you, especially if you're younger. Term policies, again, are typically written for a set period of time, usually anywhere between 10 to 30 years, and they may be renewable at the end of the term, but you will likely have an increased premium with that if you did want to renew it. There's two different types of term policies. There's level term. This is where you are locking in an annual premium for that set period of time, again, usually up to about 30 years. And then you have decreasing term insurance. So this is a renewable life insurance policy that has coverage that decreases over the policy's life at a predetermined rate. Sometimes we see this used as a form of mortgage insurance, since it can be written to match the amortization schedule for someone's mortgage. So that face value, that death benefit, is going to steadily decrease over time because you need less coverage due to paying down your mortgage. So something to think about there. Again, I know I touched on this already, but there is no cash value when we talk about term insurance, so we don't necessarily look at it as an asset when we do wealth planning. Permanent insurance. So again, permanent insurance is going to be more expensive than term, but it's going to cover you for your entire life. There's different types of term insurance that I've already mentioned. Again, we've got whole, variable, and universal life. We could spend the next rest of our day talking about those different types of permanent insurance policies, but if you have detailed questions about these, again, reach out to us offline. I don't have all the time in the world today to cover this, but I'll give you some examples. So whole life policies typically have a fixed premium, meaning you're paying the same amount each year. That'll never change. So if you're younger, sometimes we see that people like to take out or to lock in a whole life policy at a pretty inexpensive rate for the rest of their life. Universal life, again, gives you coverage for your entire life, but it has flexible premiums. So you can typically change the amount you're paying each year as long as you're paying the minimum. So, again, all of these have that one thing in common, that is, as long as you continue to pay your premiums, you're able to combine your death benefit protection with the ability to build up a cash value on a tax deferred basis that you could potentially borrow from. So you could typically, as your policy value increases, you can typically borrow up to 90% of that cash value at relatively low or zero interest rates, as long as you pay it back. Or you could just take flat out distributions from that cash value as well. You do that because it's being saved on a tax deferred basis. If you pull it out, it would be treated as taxable income to you. And if you were to take money out of the policy before you're 59 and a half, you might be penalized with that additional 10% penalty. So all things to think about. Again, permanent insurance policies are much more complex. So if it's something that you're considering or interested in, let us know. We can help you plan for that. So let's talk about different stages of life and how it might make sense to incorporate insurance into those different stages. So we're going to talk about early stages, the middle years, and then those retirees and empty nesters. So let's start with the early stages. So when we think about this stage first, you might think about someone who's young, single, probably childless, and you might think that that individual doesn't need life insurance yet because there's no one that's financially tied to them or financially dependent on them. And that might be true. So at that point in time, it might not make sense to have life insurance coverage. Although, again, I did mention this already, while you are very young, it is a great opportunity for you to lock in a pretty low premium. So even if you don't have any life insurance needs immediately, if you're anticipating life insurance needs, it might be worth exploring at that time. If you're newly married, maybe you've bought a house with your spouse, so you're financially tied to your spouse and you're living on a dual income. That might be a great starting point for you to introduce life insurance into your situation. That there's going to be can you survive if your spouse passes? Can you afford your house and your current cost of living, your current lifestyle? So it's a great way to think about introducing life insurance is when you get married and maybe when you buy a house or have that first big purchase. The next step is having kids and raising a family if you go down that road, and life insurance is going to become pretty important at this point in your life. Figuring out how much coverage you need based on your financial situation is really important. I want to share some statistics with you that I think are important to think about when we do talk about planning for insurance. So a few years ago, the USDA estimated that parents could expect to spend about $233,000 on food, shelter, and other necessities through the age of 17 for a child that was born in the year 2015. So if you add in inflation on that, you're looking at significantly more than that $233,000 number that I gave you. So something that you'll need to plan for when you're thinking about that insurance coverage is how much would we need to replace in income for our household if one of those spouses or parents in the family were to pass. Something else to think about is replacing those future costs as well. So do you want to pay for your child's education? So another pretty alarming statistic. So based on calculations provided by the College Board, college expenses for a child born this year could be about $267,000 for a 4-year degree at a public in-state university. Public in-state is typically a less expensive route for education. You're looking at private, it could cost over $500,000. So all of these points that I'm making here are things for you to factor in and consider when you're thinking about how much coverage you need. So the middle stages, those middle years, maybe your kids have grown up and are out of the house now. You probably don't need to add life insurance coverage to replace income if someone were to pass. But this is where your shift, you might want to shift how you're thinking about life insurance. So you want to think about, at this point in time, do you have any family members, friends, charities, or organizations that currently rely on you for financial support? And if the answer is yes, what does that financial support look like? And if you were to pass, what type of funds would need to be involved to replace that financial support? So your mind is kind of shifting around, your thought process is going to be shifting a little bit on that financial need for insurance here. And then that takes us into that last stage of life where you're empty nesters, you're retirees, and hopefully you've accumulated some assets and you've accumulated some wealth that you can live happily in retirement. So again, at this time, we don't typically see people looking for additional life insurance coverage for income replacement because you've built up those assets over time. But this is now where you start to plan for, maybe it's grandchildren that you'd like to have life insurance for, or maybe it's that you need to take care of a parent, an elderly parent, and if you were to pass, where do the finances come from to take care of that parent? So conversation is a little bit different at this stage. And then that kind of leads us into, who do we list as beneficiaries on our insurance? So let's jump into that. So I think a lot of us are thinking the logical choice for a beneficiary would be our spouse or our partner. And yes, that could very well be true for your situation. But something to think about and something to consider is, if it's not going to be your spouse or your children, is possibly naming a trust as a beneficiary. So why would we do this? Trust takes away some of the potential burden for a surviving spouse who may not be comfortable with managing a large sum of money from an insurance policy. Or maybe it's your children that are the beneficiaries, and maybe they're not of legal age to take care of those assets, or they're young enough that you might not trust them to take care of those life insurance assets if they were to inherit it. So a trust is a great way for you to kind of control how those assets are distributed, when they're distributed, and where they go. So something to consider is listing a trust as a beneficiary instead of a spouse or children. So another consideration, I think this is really important, not just for life insurance, but for all retirement accounts that you have, is listing a contingent beneficiary. So what this means is, the primary beneficiary is going to be that first person or those first people that if you were to pass, this money goes to them. What happens if you list your spouse and you and your spouse pass at the same time? Where does that money go? So in order to avoid probate court, you could list a contingent beneficiary and have this money go to that second line of defense. Typically, if it's your spouse as your primary, you would list your children as your contingents, or maybe it's a sibling or a parent as a contingent. Where, again, if you and your spouse pass at the same time, it's going to go to that individual or those other individuals that you've named. It really is a great way to just secure your assets and make sure they're going to where you would like them to go. And again, if you don't have anybody listed, it would end up going through the probate court process, which can be lengthy and confusing and quite challenging for those who would ultimately be inheriting that money. So avoiding that is what we encourage people to do. All right, changing topics here. So just briefly wanted to mention some benefits if you're a business owner. So just something to consider, especially for smaller businesses. I think this becomes really important, is you might want to ensure that a family member or a partner who's active in the business can successfully take it over when you're gone, and life insurance can play a role in that. So oftentimes you can fund a buy-sell agreement with one partner or multiple partners through life insurance. The death benefit would provide cash, enabling the beneficiary or beneficiaries the ability to buy out the decedent's share in the business, continue operations. Another type of insurance is key employee insurance, where the coverage would take place and cover that key employee. So if they were to pass away unexpected, the death benefit, that face value, could help replace lost revenue from losing that person, could help replace hiring costs and training as well. So something to think about for business owners. Assessing potential risks, a couple more points here to note before we get into questions if there are any. So assessing potential risks. So before approving any life insurance coverage for you, the insurance company will want to evaluate any potential risks. And insurance companies can get pretty detailed. So they're going to look at your health, your finances, your lifestyle, your job, anything else to consider. They're going to look at all of this. They're going to evaluate these risks along with the requested coverage amount. And then the insurance company will decide whether or not to insure you. So just going back to what they look at, they're going to look at your job. If you have a dangerous profession, so some things that they consider a more dangerous profession might be roofing, piloting airplanes, something like that. They're going to consider that when they come back and offer you coverage and at what rate. I'll share this because it just came up the other day. I know someone who has gone skydiving 3 times in the last couple of years, and he applied for term insurance coverage, and he's a very healthy younger individual, and he had a higher premium because of the fact that he had gone skydiving a couple times in recent years. So they really evaluate and look at everything when they're looking at coverage. A lot of insurance companies, most insurance companies do require an in-person medical exam, although I will say I have seen where you do term insurance, they might just require a phone interview and not necessarily an in-person medical exam. So it is not out of the question that you could get coverage without an in-person exam, but it is pretty typical to see that. They're also, they're going to look at how much coverage you're requesting. So if you ask for a really large policy but live on a relatively low or modest income, they're going to ask you, why do you want so much coverage? So as long as you can explain why, or you have documentation as to why you are looking for this much coverage, they will likely approve it. And then just lastly, I wanted to mention something that comes up a lot with our clients when we talk about insurance. It is disability and long-term care, especially long-term care. We get asked all the time about long-term care policies, and we can certainly help with this. We can help plan for this. I wanted to share a statistic here. So the U.S. Department of Health and Human Services issued a report in 2017 stating that someone turning 65 today has almost a 70% chance of needing some type of long-term care service or support in their remaining years. So it's a lot of people. 70% of the people turning 65 will need long-term care services at some point in their life. So planning for this is really important. I've also seen where long-term care insurance can be quite expensive, where we might look at doing a different type of insurance. Maybe it's some type of permanent insurance policy with a long-term care rider attached to it, or maybe it's just permanent insurance where you can borrow from the cash value to plan for those long-term care needs. But we can certainly help plan for this, or we can just look at some disability or long-term care insurance if that's what you're looking for. So something that's super important to talk about here. And that really takes us to the end. So, today we talked about quite a lot of information. I know I'm coming up, I've got about 5 minutes left. But today, we talked about why you should consider insurance, determining your needs. Again, we're going to be sending out that worksheet that will help determine your own needs if you'd like to complete it. We've talked about strategies for different stages of life. We talked about different types of insurance options for business owners, long-term care, disability insurance, and then again, assessing those potential risks. So that takes me to the end. Next up are questions. So if you attended the last presentation, questions are going to go the same way. You can go to www.slido.com and then type in Size Wealth 2024, and you can type in your question. It can be anonymous, and I'll get it immediately, and I can answer that now. Or if you have a more personal question and you want to talk offline about your situation, again, you can reach out to anybody on the team by phone or email after this, and we can help you with your questions. So let's see if there's any questions here on Slido. Is it true that some companies won't turn applicants down? I don't know. I don't know a clear answer to this. The companies we work with have a very diligent, thorough process in place when they're looking at, when they're doing exams and asking questions. And I have absolutely seen the companies we work with turn applicants down. I'm not sure if there's insurance companies out there that won't turn applicants down. If that's the case, I'm not so sure if it's an insurance company you'd like to work with. But the ones we work with, they're trusted, and they do a pretty thorough process in evaluating individuals. And again, I have seen people be turned down for policies. How long should my term insurance policy last? So good question. I would have some questions about your situation. Going back to that worksheet we're going to send you afterwards, determining how much coverage you need and your age is really important. So someone who's 25 might need a policy that lasts significantly longer than someone who's 50. And in addition to that, might need completely different coverage than the person that's 25 versus the person that's 50. I typically see people look at term insurance that covers the amount of time they're employed. And so typically I see people use that term insurance until they're in their 60s. I have done term insurance past that though. I did a policy a couple years ago for an individual who co-signed on a mortgage with his granddaughter. He was in his early 70s and he wanted coverage in case he were to pass so his granddaughter could continue to afford the house. He got coverage. It's definitely much more challenging to get coverage when you're in your 70s, based on medical history and issues and things like that. But I did a 10-year policy for him. So again, I want to hear more about your situation to know how much yours should last. Okay. What are the negatives of having employer provided life insurance? Good question. I'd say really there's no negatives to this. So I didn't really talk about this, but oftentimes you can get life insurance coverage through your employer. That is a fantastic way to get coverage that is really inexpensive, oftentimes little to no underwriting involved in getting that coverage. And the expense of it usually comes right out of your paycheck. So that is a fantastic way to get life insurance coverage. I typically see employers offer you can get coverage that might be anywhere from 2 to 10 times your current salary. That's a fantastic way to get coverage. That's a great start to making sure you have some life insurance coverage and then figuring out, do I need another term policy to supplement that is the next step to going about that. That no, employer coverage is fantastic. All right. What's the death benefit for a $3,000 face value whole life policy with 2,500 plus in paid up additions? So I don't know who submitted this question. Maybe we can talk a little bit offline about this. I'm going to need to know more about the situation here. And you reference death benefit and face value. I'm wondering if that you might mean cash value instead of face value there. Whoever this is, maybe reach out to me after this and I can help you a little bit more with what you're trying to ask here. It is 12:30. I'm happy to continue answering questions if there are any. I know we've reached our 30-minute limit though, so if anybody has to drop off, feel free to. But again, if there's any other questions, let me know. All right, it doesn't look like there's any other questions. I just wanted to say again, thank you so much for your time this afternoon. If you have questions about your situation, reach out to us offline. We're happy to help. hopefully this presentation was helpful. And again, we'll be following up with that worksheet. If you'd like a copy of this presentation, we're also happy to send that out. So thank you all for your time today and enjoy the rest of your day. Thank you.